Hi, everyone. Welcome to this webinar. Thanks for joining today. As many of you know, we'll be covering both the macroeconomy and flowing that into our view on the oil market. Today, I'm joined by Viktor Katona, who is our head of oil and oil analysis. I myself am head of macro here at Kepler. I'll be opening up the presentation, looking at a number of key economic blocks, giving my outlook for where I believe things are going on the macro side of things. And again, as I mentioned, I'll be handing it off to Viktor to talk about the oil side of the market. Let's go ahead and dig in and first look at headline growth. Take a look at our forecast for this year. I see growth this year coming in at 2.4%. That is a 20 basis point decline in growth relative to 2023 levels. A lot of this is due to a moderation in growth across the U.S. economy, albeit, as you can see in our forecast in that right chart, we still see U.S. growth coming in at 2% this year. That's roughly in line with the long-run trend. India will lead the pack in terms of the large economies, growing at 7% this year. We see China growing at 5%, i.e. they will push to meet their 5% growth target. And we see Europe likely lagging the group, growing at just below 1%. If you look at Africa, we see growth at 3.4%, and across broader Asia, growth at roughly 3.8%. Let's jump into the United States first. Obviously, this is kind of been a lot of the focus across macro world over the last 24 to 48 hours with the Fed FOMC cut. I would say the central narrative when it comes to the United States right now, if you had to explain it in one word, is divergence. Divergence. The U.S. has a number of economic data points that are making it very difficult for the Fed to set forward policy right now. On the one hand, you have strong household consumption. The headline economy continues to look pretty strong, and yet the U.S. labor market has weakened a lot. If you look at the chart on the right in particular, right, in Q2, we had growth at roughly 2.8%. That's well above your long-run trend of 2%. And even into Q3, now casting models show U.S. growth averaging 2.5%. So again, a lot of strength across headline U.S. GDP growth, and yet we've seen the unemployment rate from the middle of last year tick up from 3.5% to levels closer to 4.2, 4.3%. Interestingly enough, we saw the Fed yesterday decide to aggressively begin the rate cutting cycle. They said they issued a 50 basis point rate cut. This was above our expectations, which had a 25 bip cut in September. And so they are definitely taking the more aggressive path here. We think that there are distinct risks of taking such a path that I'll talk about a little bit later in the presentation. First, if we just dive into this idea of economic divergence, you can see here, right, unemployment has trended higher. And yet, if you look at U.S. GDP in the chart to the right, we are now well above the pre-pandemic trend level, right? If you look at that green dotted line, that's where I would have expected GDP to be at this point. And yet we are, and have held stably above that level now for several quarters. And so this is a clear problem for the Fed. They're trying to understand, is the labor market really weakening at the rate the market is kind of expecting right now, or is the U.S. economy doing okay based on GDP figures? And so just diving into this idea, first let's take a look at the GDP and consumption side of the U.S. economy. Keep in mind that U.S. consumption, household consumption, is roughly 70% of GDP. So if U.S. consumers continue to spend, the U.S. economy will continue to perform pretty well. And if you look at the chart on the right, this is real retail sales, so removing inflation and also removing expenditures on food and energy. So just looking at those core expenditures, we finished up month over month, every month this year, except January and April. So that upward trend that we saw through 2022 and 2023 continues to hold in place into 2024. And again, just looking at it in absolute trend terms, that chart on the left, you'll notice that U.S. household consumption, again, is holding at 2 to 3% above pre-pandemic trend. This is a level we've held for almost 3 years now. So again, at least when it comes to the just headline U.S. economy and the U.S. consumer, things look pretty strong right now. This is also supported by very elevated deficit spending levels. If you look at the chart on the left, the blue line is deficit spending as a percent of nominal GDP. Typically, in the pre-COVID era for the United States, say the previous 40-year period pre-COVID, in times when the U.S. economy was growing, you tended to see a deficit as a percent of GDP level at roughly 2.5 to 3%, right? Last year, despite very elevated expansion, deficit spending was 6.5% of GDP. We expect that's going to be roughly the same level this year, between 6 and 6.5%. So we are deficit spending at a much higher level than we tend to see in periods of economic expansion. And this is also providing support to growth. However, it's also inflationary. And if you look at the chart on the right, interest payments in the United States have rapidly accelerated. That orange line have rapidly accelerated as interest rates have increased. This year alone, the U.S. will likely have $1 trillion bill just to pay for interest payments. So this is also inflationary, right? It supports growth, but it's inflationary. However, so you have these factors that the Fed's kind of weighing, right? Strong economic growth continues, consumer continues to spend, a lot of deficit spending. However, on the offset to that is a weakening labor market to a degree. If you just look at non-farm payroll gains, the chart on the left, month-over-month payrolls have trended lower over the last 6 to 12 months. However, we do want to emphasize that relative to, say, a pre-pandemic norm, we're not necessarily far outside the norm right now. We're just declining off a very elevated level that occurred in the post-COVID period. And there are really two arguments that I'm kind of making to clients right now that I would argue the U.S. labor market is not as weak as, say, the headline unemployment rate indicates, which I showed a few slides ago, has certainly trended higher. And again, we're holding at that 4.2 to 4.3% level. But again, I think that there are a couple of key points to kind of note here. First, just looking at initial jobless claims, which is that chart on the right, that black line, which is 2024 initial jobless claims, have held at or below year earlier levels for much of this year. And keep in mind that initial claims are a good indicator, a good leading indicator for the U.S. labor markets going. And we really haven't seen a big increase in initial claims relative to year earlier levels. Even today, we got initial claims coming out. That's on Thursday when we record this webinar. Claims have started to decline in line with seasonal expectations. I've been arguing we would see this, and we're starting to see that flow through to the data now. Another key factor kind of consider when it comes to the U.S. labor market and trying to consider, is it as weak as that headline unemployment number is kind of indicating, is just considering measurement errors and the pace of labor force expansion. So if you look at the chart on the left, this is just average labor, the absolute labor force level in the U.S., and that bottom panel on the left chart is the rate of increase year over year. And you'll notice that post-pandemic, we've seen a big recovery in the U.S. labor force. A lot of this has been driven, half of it actually has been driven by foreign-born labor. Immigration into the United States has played a big role. Through 2022 and 2023, each of those years saw on average, through both of those years, 1.5 million per year in additional foreign-born labor, right? This is easily more than double the maximum levels we saw pre-COVID. And you can see in the chart on the right, in absolute terms, foreign-born labor against pre-pandemic trend is now well above trend, right? And the issues with this are kind of twofold. One, the BLS is likely having issues measuring this effect on the labor market. So there are likely some measurement errors, specifically within the household survey, that we need to be cautious when watching U.S. labor market figures as they're reported on a monthly basis. And number two, in my view, I think the large expansion of the labor force the last couple of years has helped to drive the unemployment rate higher, just simply because you're adding a lot of workers back into the labor force. This isn't necessarily a negative for long-run growth in the United States. Keep in mind that long-term GDP growth is supported by population growth. And so, again, these two factors, right? The fact that maybe, in my opinion, the U.S. labor market is a bit more stable than the headline unemployment rate is showing, driven by the fact that initial jobless claims are not necessarily weakening considerably, and the fact that we've seen a big increase in the U.S. labor force. It is our opinion at Kepler that the U.S. Labor market is not as weak as the headline unemployment rate would indicate. So where does this kind of lead us? Right now, clearly the Fed has taken an aggressive cutting stance, as I indicated, because of their concerns about the labor market. They cut 50 basis points, despite the fact that the U.S. economy continues to perform pretty well, at or above trend. Our concern, especially into next year now, is that as the Fed continues to pursue what appears to be an aggressive cutting cycle, we could see a reacceleration in inflation next year, especially if the U.S. economy continues to hold up, which is our expectation. And if you look at these inflation statistics, specifically looking at the right chart, which is core inflation, removes food and energy, those blue bars are the 1 month inflation rate annualized. Obviously, this is very volatile, but you'll notice that those 1 month inflation figures have ticked higher off the summer lows. And it is our expectation that, again, inflation could be sticky and could possibly accelerate next year if the Fed continues to cut and the U.S. economy continues to perform pretty well. Obviously, the labor market is a concern, but as I mentioned, I think the labor market is a bit more stable than many in the macro community currently assume right now. So our fear, and something that I think clients need to prepare themselves for, is that the U.S. sees another bout of inflation into next year, which could put the Fed in a difficult situation. Just one other slide looking at the U.S. presidential election, which is coming up here in early November. We're getting close. Harris is holding at roughly a 3 to 3.5 percentage point advantage to Trump nationally. She's going to need that polling average to hold at least in this range for her to have a hope of winning the presidential election, just given how the Electoral College works. It is key to watch Georgia and Pennsylvania. She will need to win those states if she has any hopes of winning the election. If Trump pulls one of those states, he is likely to win. Keep in mind that when we're thinking about both presidential campaigns and potential policy into next year, the next 4 years, we think both Harris and Biden are inherently inflationary. That is their economic policy is inherently inflationary. However, we think the Trump administration is a bit more inflationary than Harris. Our expectation is Harris would, if she were to enact her policies, would likely see the U.S. Budget deficit expand by between 1 and 2 trillion over the next 10 years. Trump's policies would likely expand the deficit by somewhere between 5 and 6 trillion over the next 10 years. Also keep in mind that Harris and Trump would likely pursue a lot of fiscal deficit spending. Harris and Trump would also look to cut down on illegal immigration, which has played a key role in pushing up that labor force growth that I spoke about a couple of slides ago. That would also be an inflationary impact. However, Harris would not pursue the kind of aggressive import tariffs that Trump would pursue. that would also increase prices on the side of the Trump administration. All right. With that being said, let's go ahead and shift to kind of the other juggernaut in the room right now, and that is China. I'd say if the U.S. is characterized by divergence, I would say the one word for China would be imbalances. The core problem for China right now is they are continuing to try and find growth via the investment channel. The problem is that this investment-led growth story in China is really starting to come under pressure now. Keep in mind that the Chinese economy, 40 to 45% of GDP is investment. These are things like building infrastructure, factories, and property, housing, whereas 30 to 35% of the Chinese economy is household consumption. It's like going out to eat, going on vacation, buying goods and services. This is very different from, say, the United States, where roughly 70% of GDP is consumption, and investment is somewhere in a range around 23% of GDP. China's long-run growth prospects really require that it shift to a consumption-led model. And so they need household consumption as a percentage of GDP to increase to a level between, say, 55 and 70% of GDP, up from the 30 to 35% range it is currently. And investment needs to come down a lot closer to levels around 20 to 25%. This process of shifting away from investment and towards consumption is a very difficult process that I'll talk about a little bit, but I think it could prompt China to go through a period of stagnation over the next 10 or 15 years because they've really waited too long to start to try and push this conversion towards consumption. I think it's very possible that over the next 10 or 15 years, China's growth rate flattens out at or slightly below 2%, and kind of follows the path we saw Japan follow, say, starting in the mid-90s, where they really struggled to find growth as they shifted away from their investment-led growth model. But let's dive into a little bit more on these issues, and also what's happening in real time. If you just look at the investment side, just looking at this right-hand side chart, the Chinese government publishes what is known as the macro leverage ratio, which is just total economy debt to GDP. You'll notice in Q1 of this year, debt accumulation expanded by 6.8 percentage points. This was a considerable uptick in debt accumulation. And what you'll notice is a lot of this flowed right into the investment side of the economy, as we had expected. China went back to its playbook that it's gone back to a lot over the past decade to drive growth and meet its 5% growth target. And you can see that in the chart on the left. Manufacturing fixed investment, that orange line, surged to 13.4% early this year. We also saw industrial production, that blue line, pushed to 7% early this year, up from sub 5% in Q3 of 2023. However, what you'll notice is that debt accumulation has slowed into Q2 and likely into Q3 as well, albeit we don't have official data yet. And the way that I can kind of tell this is the fact that fixed investment now has flatlined or declined a little bit. Same thing with industrial production growth. These areas are still growing, but that growth acceleration has stopped. And the fact is that for China to really drive investment growth higher now requires very high amounts of debt accumulation. The Chinese government understands this and likely explains why they stepped back after Q1 and why we've seen issues in the Chinese economy really start to percolate over the last couple of quarters. This investment-led growth model just requires a lot of debt accumulation, and the Chinese government is being careful how much of that they want to do. Also, you have issues around reliance on exports. China now is relying so heavily on investment and production, manufacturing production, to drive growth. There is not enough domestic demand to absorb all of this production. And so China must rely heavily on exports to soak up all of that additional production. And you can see in absolute terms this year, on a monthly basis, Chinese exports are up 12 or 13 billion dollars per month year over year on average this year. In percentage terms, this is a 4 to 5% percentage point increase on a month over year over year basis so far this year. And this is even showing up in the trade balance. That right-hand chart, that black line over the last couple of months is holding at a net surplus that we have not seen really ever in the last 20 or 30 years within China, right? And all this shows is that they're relying very heavily on exports to absorb excess production within the Chinese economy. A perfect case study for this is the steel industry. If you look at the chart on the left, the orange line is crude steel production. The blue line is construction starts. Obviously, the Chinese property market is a heavy user of steel, right? And you would expect that as the property market declines and contracts heavily, crude steel production would also decline. But the Chinese government has really pushed to keep crude steel production levels at relatively consistently elevated volumes. And of course, as construction starts have declined, what you'll notice in the chart to the right, as the reliance on exports has consistently increased. The trend really began in 2022 and it's continued into 2023. However, the problem with all of this export-led growth is that economies around the world have to absorb all of these cheap Chinese exports. This tends to displace manufacturing and production bases in these other economies. And there comes a point when these other economies want to protect their own domestic industries. And so you have import tariffs being implemented everywhere. Brazil, Chile, Mexico, the United States, the European Union, Canada are all actively or have already implemented Chinese import tariffs in an attempt to protect domestic industry. And a perfect example is Brazil. In March of this year, Brazil, which is a heavy importer of Chinese steel, they went ahead and implemented a 25% import tariff on Chinese steel products after roughly a year of deliberation. And you're going to see these import tariffs become increasingly more aggressive, and this will make it harder for China to continue growing via the export channel, and which is a reason why I'm arguing that ultimately China needs to find a way to shift away from investment and towards consumption as a percentage of GDP. And just on that note around household consumption, if you look at, I love looking at just absolute retail sales in China against pre-pandemic trend. We're now, 10 to 15% below pre-pandemic trend, right? The household consumer in China is really underperforming. And if you look at inflation levels, that black line in the right-hand side chart is Chinese inflation on a year-over-year basis has remained below 1% for more than a year and a half now, right? Really, really weak inflation numbers. And this makes sense, right? China's producing a lot of goods and household consumption is pretty weak. That's going to depress prices in China. And so I get a lot of questions like, how do you start to fix this problem? It's not easily fixable, I'll admit. The Chinese government would need to dramatically increase fiscal transfers to households through higher government benefits, a removal of the hukou system, and even maybe just direct payments to households, while simultaneously finding ways to reduce subsidization within the investment sector. But doing this is politically very difficult because the moment you start to increase transfers to households means a loss of control in terms of setting economic policy and direction if you're the Chinese government. It's just harder to dictate how Chinese consumers spend money versus setting an investment and industrial policy. It's much easier to set direction that way. And so it's politically very difficult for China to do this. Also keep in mind that the demographic problem in China, it's declining. Demographics in China are now declining also make this a really difficult proposition. So it is our expectation that this process of transition will be very painful, and clients really need to get out of the frame of mind that we're going back to the kind of growth rates that we saw in the 2010s in China. I think over the next 15 to 20 years, as I've mentioned, China is going to struggle with a lot of secular stagnation and a growth rate, of around 2% looks a lot more likely moving forward. All right, let's shift to our third kind of big economic block here. If we're looking at the U.S. and talking about narratives, just that one word again, I would say is divergence. As I mentioned, for China, it's one of imbalance, and for Europe, I would say malaise, economic malaise. And the problem Europe faces right now is a duality of low growth and sticky inflation. And this is putting the ECB in a very difficult situation. They need to cut rates because growth is relatively weak, and yet inflation continues to show signs of getting stuck at this 3% level. This was a real problem and a textbook definition of economic malaise for an economy. When you have high inflation and low growth, that's really a problem, right? And a really an issue that's not easy to fix. We do see growth in Europe picking up this year to 1%, up from around 0.5% last year, but this is hardly what you would call a surging economy. And so the European Union, again, is trying to thread this needle between cutting rates, but also watching relatively persistent inflation. And if we just look at the inflation picture right now, if you look at this left-hand side chart, this is core inflation, again, removing food and energy. You'll notice a clear tick up early this year, and now we've kind of gotten stuck at this 3% range across core. If you look at the black line, again, this is just your inflation rate over the last 6 months. We're kind of stuck in this 3% range, and this is a problem, right? This shouldn't really be happening when growth is at 1%. The problem is that rent inflation, which if you look at the chart on the right, services inflation, which includes things such as rent and housing and healthcare spending, has shown itself to be quite persistent this year. And also Europe continues to face supply side constraints. You have issues with the Red Sea, higher freight rates that occurred earlier this year, also really affecting Europe. And so this is a big problem, right? And so, my question, clients will often ask me, where is, is there an area of optimism for the European Union this year? And I'd say, if anything, it will be the household consumer. If you look at confidence levels, say since the war in Ukraine, that chart on the left, specifically that blue line, has really recovered a lot off the lows we saw from 2022. Our hope is that starts to lift retail sales a little bit. If you look at the chart on the right, we've started to see a slow tick higher in retail sales after flatlining last year. My expectation is this is going to continue. The gradual uptick that we've seen so far this year will likely continue. That will help to bring European growth rates to that, roughly 1% growth level this year, up from, 0.5% last year. It's going to be the consumer that plays the biggest role in helping Europe see any uptick in growth this year. Unfortunately, and one last point just on the labor market, again, looks supportive for household consumption. If you look at unemployment, we're at a 2-decade low, right? So the unemployment picture is pretty tight in Europe right now, should help household consumption. Unfortunately, when you look at the investment side of the picture, left-hand side chart is manufacturing production. It is at a multi-year low. You look at construction volumes now trending lower into this year. This trend is going to continue until the ECB can significantly ease monetary policy. But again, the ECB in a tough situation right now because they're facing sticky inflation on the offset. So the question is, do they go ahead and continue to cut rates and just allow inflation to run hot? Or do they take a more gradual approach over the next year? It's really an open question, and a reason why the ECB right now is arguing for data dependence meeting to meeting. Just a couple of other economies before I hand over to Viktor. Let's talk about India next. If I have to choose one word for India in terms of economic narratives, one or two words, I would say economic outperformer. As I mentioned early in this presentation, I see a 7% growth rate for India this year. That's very healthy. First quarter growth was strong. Through the first half, growth was over 7%. Again, we see this trend continuing through the second half, driven not only by strength across the consumer, across investment, which we saw last year, but also strength across the consumer, who actually underperformed last year. So we argued coming into this year, and we have seen that so far this year, a pickup in household consumption growth as well. If we look at the investment side of the equation here, just looking against my seasonal pre-pandemic trend again, real investment levels have absolutely surged to well above where I would have expected things to be, say, in 2019. This is helping to drive commodity demand all over the place. If you look at metallurgical coal imports, growth continues to drive higher because of the need for steel production. So again, India likely over the next 5 to 7 years will likely be a big investment growth driver across the global economy, and will certainly help to be a bright spot when it comes to core clean product demand for gasoline demand, gas oil demand. India will be a bright spot, a relative bright spot, especially as Chinese consumption growth levels for say core clean products start to flatten out. One last economy here, just touching on Japan. Economic narrative for Japan would be relevant again. Namely, Bank of Japan policy is very relevant again, actually, after not really having a lot of relevance for 10 or 15 years in the pre-pandemic period. Japanese growth starting to pick up again. We saw Q2 growth push back to 3.1%. This shows that they may be exiting what was a period of economic weakness that began in mid-2023. We've seen a pickup in wage growth as well. While inflation has come back down to trend, there are concerns that we could see a reacceleration in inflation in Japan in the coming months. This is really relevant for investors because of how it could dictate Bank of Japan policy moving forward. We have seen, as I mentioned, Bank of Japan relevance or Japanese relevance again. That's being driven by the fact that the Bank of Japan is raising rates again, right? And again, last decade, they'd held rates at 0 or negative for a long, long time. The fact that they're now raising rates at the same moment, the US Fed and the ECB and some other central banks are cutting rates, is that it implies yen strength. And keep in mind that this could inject volatility into the market because of the yen carry trade. You have a lot of folks in the market who are borrowing a lot of yen at a 0.25 or 0.5% interest rate, and then going and buying US or Mexican fixed income. That is government bonds that yield 5, 6, 10% and receiving a nice carried return on that trade. However, if the yen strengthens considerably, as we saw in early August, that could inject volatility as people have to unwind those trades. We certainly saw some yen carry unwinding in early August. That could happen again if we see the Bank of Japan continuing to hike rates. So I think for investors and folks watching the market, it's important to keep an eye on the Japanese economy. If it remains relatively robust moving forward, that could put pressure on the Bank of Japan to continue tightening to prevent another acceleration in inflation like we saw last year and the year before. And this could strengthen the yen, and that could push the yen carry trade to unwind and inject volatility into the market. All right. With that being said, that is the macro side of the presentation. I think Victor's got a couple of questions for me, and then I will hand off. I'll hand off to him.
Perfect. Thanks, Reid, very much. I mean, a brilliant presentation. It very much correlates with what's going on in the oil markets. But you know what? My biggest sort of question is, you very often hear that we shouldn't really expect infinite growth on a finite planet, that our resources are limited, et cetera, et cetera. And that's very much a talking point in Europe right now because growth has stalled so much. Do you think that we would ever see a global GDP growth rate that we have seen in, say, in the 2000s or 2010s? Or we should just adapt to a much more modest rate of growth in everything across the board?
I think we will absolutely see a structurally lower GDP growth rate over the next 10 to 15 years, simply because you're not going to have the China element involved. Keep in mind that 10, 15 years ago, China was growing at 10%, right? 10, 12, 8, 10, 12%. These were very high growth levels. You won't see that again in China. And while places like India and Southeast Asia will help to provide an offset to that somewhat, they're not near as big as the Chinese economy, right? India, for example, is 1/4 the size of the Chinese economy, 1/5 the size of the US economy. And so I think that investors and folks across the globe need to get used to what will likely be a structurally lower growth rate over the next decade for sure.
Mm-hmm. I mean, India, again, is very much the hope of the oil markets as well. But I kind of feel that India is the known unknown, right? Everyone expects India to perform relatively strongly compared to the markets. Do you think that there's anyone else out there that could be an India of the 2030s or 2040s? Is there a region that's still underperforming and could perform so much better?
I think Southeast Asia could definitely be one of those regions. Places like Thailand and Vietnam, I think, have a very positive outlook. The thing is, these regions are not a single unified whole like China, right? And so you're not going to see the same kind of growth story that you saw in China because obviously the central government was directing massive flows into investment. It was a very unique situation. Even when you look at the Indian economy, right, they're not going to follow the Chinese model exactly, right? It's a much more free and open economy. India is actually a consumption-led economy. Roughly 30% of GDP is investment, but a big portion of their GDP is consumption. And so I think actually over the long run, if just focusing in on India for a moment, I think that their long-run growth rate is probably between 6 and 7%. And they'll likely be it'll be a lot more healthy growth than China, just because while they will emphasize investment, consumption will play a lot larger role in the Indian growth story over the long run. However, that probably means you're not going to see the 10, 15% type of growth rates that you saw in China over long periods of time. So that's the offset. But to kind of go back to answer your question, I think places like Southeast Asia, Thailand and Vietnam, at regions like that could, also be positive growth areas for the U.S. For the global economy. And just one other point on that, a lot of people asking about the African continent as well. Obviously, just because their baseline is so low, you could see relatively solid growth rates there. However, a number of nations need to figure out their political issues, need to find a way to deal with the massive problems around corruption, because ultimately the states in Africa need to attract a lot of foreign direct investment. In order to do that, you really need to clean up the political systems across a number of these states as well.
So you're not a big believer in the Nigerian super story?
Not necessarily, unless we could see a lot of political reform that emphasizes the rule of law. I think it could be quite difficult for Nigeria to attract a lot of foreign direct investment, which is what they need to grow right now.
Perfect. Well, I do definitely see a lot of correlation between the big trends, the large trends in the macroeconomy, and what are the hopes of the oil bulls are. And I'll try to present that right now in the oil presentation, because effectively what we have seen over the past couple of weeks, really, and very much over the time span of September, arguably the most depressive month that I've ever felt in the oil markets, maybe barring 2008, 2009, and the COVID period, is specifically this. And effectively what has happened is trust in the oil futures, trust in oil as a commodity has pretty much collapsed to the lowest in the post-pandemic period. It's a very, again, divergence is the keyword or the buzzword of our presentation, and it's very much a divergence in the oil markets as well. Because if we go into, let's say, the positioning data in Brent has never been this negative. In fact, Brent has never been negative, full stop. And it very much dipped into negative territory by mid-September. And again, you look into how the algorithmic traders are trading, massively bearish. The overall sentiment is that we have reached a period when wars no longer make an immediate impact on supply and demand. We have learned how to trade wars and geopolitical conflict, how to effectively circumvent the disruptions. And at the same time, demand has started to decline and supply is still relatively healthy. And the combination of those three things in one effectively have brought us to a level where we have slumped $10 in just 1 month. At the moment of this specific recording, we're still trading Brent at $72 per barrel, and that's quite a surprise for the markets because it shouldn't have happened this early. At the same time as we are effectively by late September right now, we still have an oil embargo in Libya. We have had Hurricane Francine. We have had all sorts of market disruptions. We even had the US federal interest rate hike, and the market reaction was just so lukewarm, was so timid, that effectively it makes you wonder whether there's a future for crude as a commodity, not in 2024, but say in 2034 or 2044, or have we actually reached the limits of how far we could actually go? There's one very interesting divergence, and specifically the market interest in investing in oil is very much going towards the negative. Yet at the same time, backwardation is actually starting to pile up. Look into the Dubai futures. The Dubai futures have had a very weak August. In September, the Dubai futures are going up. Why? Because physical buying is actually not that bad. Generally, demand is not declining. You would believe, just looking at the numbers, that demand is declining. It's not. It's just not growing the way that everyone anticipated it to grow. And a large part resides in this specific chart. After a quite impressive post-pandemic recovery in terms of growth right now, we have reached the limits of how far China could go. As Reid has very much stipulated in his presentation, there needs to be more domestic consumption in China to trigger something more aggressive in terms of their demand for oil. In fact, their appetite for oil has been quite weak. Yet at the same time, supply across the universe, especially the non-OPEC supply, and non-OPEC isn't necessarily even the US shale, which has been the star performer of non-OPEC supply in 2023. We're increasingly moving into a period where a set of countries is having recurring year-on-year increases at a moment when demand starts to slow down. And demand starts to slow down very much to the effect that in 2024, pretty much the consensus expectation for demand growth is 1 million barrels per day. And our expectation is that we slip below 1 million, roughly to 800,000 barrels per day on core product demand in 2025. Now, if you just look at non-OPEC supply in 2005, next year effectively, you see that it's roughly equivalent to demand growth. So is there any space for OPEC plus barrels? Was OPEC plus's postponement of its unwinding of the third wave of production cuts, was it a harbinger of things to happen in December as well, and maybe also in 2025? We think that yes. In fact, OPEC Plus will be forced to postpone, or rather even cancel, the return of its barrels into the markets. Why? Because effectively there's no space. The only space for OPEC Plus barrels could be if Libya goes down in a bloody civil war and stays there for the upcoming years. Beyond that, effectively, non-OPEC supply very much satiates the demand that effectively is created in the market naturally. And beyond that, there's no more space for producers out there. Of course, I mean, there's always a caveat, right? Technically, OPEC Plus countries could bring oil into the market. Then oil would collapse into levels that are pretty much not only difficult to manage fiscally for massive OPEC plus producers such as Saudi Arabia, Iraq, or Kuwait. All of those countries right now see an oil price that's below their break-even level. We're nearing a stage when even the most confident and the most solid, robust OPEC plus producers, say the United Arab Emirates, even they start to look at the oil price and think, how much do you actually have in profit after all this is gone? And this is very much the reason. And again, I need to differentiate between what do I actually think about the non-OPEC supply growth, because the big story, the US supply growth story, is gradually tapering down. We see a roughly 300,000 barrels per day increase in 2024 and a roughly 300,000 barrels per day increase in 2025. My personal belief is that the 2025 base case figure that we have would get lower because it doesn't really have the impacts of a massive freeze in the winter. We calculate hurricane impacts, but most probably the supply growth will be somewhere between 200 and 300,000, pretty much equivalent to Brazil's. Canada, one of the most solid performance year on year, brings a fixed amount of incremental supply into the market, will also add another 200,000, and Guyana will have a new FPSO by September 2025 up and running. If you just add all of these four countries, you pretty much see the absolute satisfaction of next year's demand growth. Where could potentially Saudi Arabia put its incremental barrels? Well, pretty much nowhere. And the funny part about non-OPEC, really, as a collective, as a collection of countries, is that you would think that there are countries which lead non-OPEC in terms of incremental supply, but there should also be laggards, right? There should be countries that effectively are the star underperformers, the worst of the worst. The United Kingdom has become one of the underperformers. I mean, the regulatory pressure on oil producers in the United Kingdom is pretty much one of the worst that one could imagine. And it's going to even get worse now that the windfall tax rates are going to get even higher. But oddly enough, a country that's affiliated with OPEC Plus, although doesn't necessarily have a production target, Mexico, has seen the worst performances of 2024 and will also see the worst performance of 2025, which means that the declines in non-OPEC countries are small. So the countries are quick to grow, but they are slow to decline. And the combination of this to effectively creates, the perfect cocktail for OPEC Plus to just stay stuck where it actually is. I'm very bullish regarding Brazil next year. I think that Brazil will be the factor in the market that a lot of people have given up on. Brazil has had a dreadful year in 2024, and just if you look at the entire year of 2024 on the whole, it very much seems that Brazil is geared towards a year-on-year decline. A thing that no one anticipated. Brazil was growing year in, year out. But in 2025, Brazil has 4 new FPSOs, and everything that they couldn't do in 2024, they will do in 2025. And then the Atlantic Basin gets saturated with incremental supply coming from Petrobras's deepwater offshore fields or from ExxonMobil's Stabroek block, which again is one of the most consistent performers, bringing in new fields, new supply every single year pretty much by now. And it won't stop even by the end of this decade. It won't really stop. Guyana would be producing 1.2 million, and it's still not over because the resource is just too big. So I think when we think about non-OPEC, we very often think immediately of the US shale supply. The US shale supply, in our vision, would basically peak in 2026, and from then onwards it plateaus. However, non-OPEC supply has much more resource to tap into. And again, Latin America would be very much the key driver, plus Canada, in leading non-OPEC supply to even higher levels than it currently stands as. Now, this presents a huge headache for the Middle East. The Middle East has been ongoing a transformation from a period when it was very much just an oil exporter into a much more sophisticated role, tapping into more of those higher value opportunities out there. Very much the refinery expansion that we have seen in the Middle East, and the proliferation of Middle Eastern middle distillate exports into Europe is very much a sign of that happening. The refinery expansion in the Middle East are coming to an end. Effectively, with Bahrain's Sitra refinery finalizing its expansion, there's no big project on the timeline that could be potentially tapped into in 2026 or 2027. What it effectively means that the only means of OPEC plus countries to bring back incremental production into the market without telling the market, without, I don't want to use the word, but I'm still going to use it, without hiding incremental production in its refinery capacity, the only way out of this would be, first of all, to consume less of its own crude, not to burn it for power, as is still the case in Saudi Arabia or Kuwait. Huge amounts of crude are burned for power generation, and to increase the share of condensate, which is not reported, doesn't really go anywhere, and you don't really need to tell anyone about how much condensate a specific country produces. It's just out there and it comes out, and there's no obligation to report. These are the two options that are the most convenient ways of increasing exports, yet at the same time not doing a media campaign about it and effectively hoping for a higher oil price whilst having higher supply. Beyond that, we think that what we see right now in terms of Middle Eastern production would effectively be capped in 2025 and would most probably be capped in 2026 as well. So basically, we're stuck at the level that we effectively stand. There could be, of course, a surprise cut further. You never know how, what life brings you. The demand concerns might get so bad and prices might get so low that effectively there would be the temptation for another production cut. But most probably, that's not going to happen. Most probably, we're just going to linger around the current edges. So effectively, Saudi Arabia and Russia at 9 million barrels per day. Exports, of course, might go higher. Exports are, there's still a lot of crude being burnt, as we have discussed. That could go into exports. More condensate could go into exports. But overall crude production, we think that the era of the seesawing of those production targets is largely over. And this is the new reality. The new reality is an oil price, which we believe to be somewhere around the edges of $75 per barrel for Brent. We also entertain the possibility of a higher oil price toward Q4 2024, because first of all, there needs to be just a technical recovery. It's just, there's way too many people in the bearish boat right now, and that boat is going to overfill. At some point, there needs to be a sentiment shift where we actually see something in the oil markets than just pure pessimism. And second of all, I still think that a lot of the forecasters, a lot of the analysts, a lot of the people in the community, they still entertain this dichotomy of having a low flat price forecast and at the same time believing that OPEC Plus would bring back oil into such a low price environment. We think that, again, OPEC Plus would be forced / would actually postpone its unwinding of the cuts. And the December meeting of OPEC Plus in Vienna, we think that's an opportunity where when oil prices could get higher, because still a lot of people price that into their outlook for Q4 2024 and 2025 as well. So there could be a slight upside. Beyond that, the farther down the road of this economic malaise, of weaker Chinese demand, of insufficient offsetting from China, for European demand effectively just going lower and lower. The farther down the road we go, the less interesting it's going to become. So we think 75 is the new norm, and 75 pretty much stays the target for most of H2 2025 as well. What's interesting also happening in the oil markets is, and very much, this is attesting to the fact that people no longer see the future in oil, and potentially, again, we're talking about 2027, 2028, the years when oil demand growth, in our perception, would start to peak. We see an oil demand growth in 2028 and 29, and then a 5-year plateau from then onwards. You see that in the 36-month spread. If you just look at the spread between where the current front month, November 2024, stands and where, 3 years from now, the 2027 contract stands, the difference between the two used to be $10 per barrel a month ago. Right now, it's 2, or at best, on a good day, 3. And that very much tells you that the market doesn't really anticipate that there's an upside, doesn't really see that there's a potential for higher growth in a combined environment of higher supply, effectively oversupply, if you want to call it the correct name, and slackening demand growth. Now, this is the depressive sort of a negative part of what I say. Just looking at the flows figures and the amount of global crude on water that we have, it is indeed very negative. But also, I would say that in terms of the physical movements, in terms of the physical trades out there, it actually looks better into Q4 2024 this year than the summer actually felt. Because the summer, from my point of view, was very much the low point of the year, sentiment-wise. A lot of people expected that, you know, China would finally have what everyone expected. China would have an inventory build. China would buy more. China would finally start to, you know, fire on all cylinders. People expected trade not to go down the way that it did, you know, more flows, more activity, refineries coming online. And that didn't really happen. Yet some of those effects would be postponed into Q4. Prices are finally looking good for buyers. That, or the, you know, the flat price is, for instance, in Asia, that by definition is very much appetizing. But also the differentials that we see, the arbitrage opportunities, they are not as wild as they used to be. Think about, you know, 2022, the arbitrage between Asia and Europe basically couldn't be worked at all. It was impossible to penetrate the two continents. Right now, it's quite manageable. Freight. We have seen a string of crude tankers being washed out and reutilized for diesel exports out of the Middle East into the European continent. Why is this? Because freight is quite manageable. I mean, the shipping companies see more advantage in doing this than relying on, say, Saudi Arabian VLCC exports into China. But again, this also means that freight isn't expensive. Freight could be a potentially good story into the autumn months and the purchases that we see there. And specifically looking into China, I very much expect an uptick in Chinese purchasing demand. Of course, everyone looks into, you know, Chinese nominations of Saudi Arabian barrels, which is a good proxy for how much they would buy. What we see effectively into October, that from an extremely weak summer months, say 34, 35, 36 million barrels per month, China has moved up to 45, 46 million barrels per month. So it's a gradual recovery, again, into the period where pretty much no one anticipated it happening in September, October, and November. But we're moving into that period when they edge higher. They also didn't stop buying Iranian crude, you know, arguably the cheapest medium sour that you can buy on the market. It might not be fully legal, might not be fully transparent. But again, if you're in for something which is price competitive, you just maximize the Russian, you just maximize the Iranian, you maximize the Venezuelan, and surprisingly and luckily for the Chinese refiners, also the Middle Eastern barrels, they get more competitive. Now, why is this important? It's important because China didn't really have the inventory buildup in the summer that everyone expected. In fact, Chinese stocks are quite low. They're pretty much walking the same trend line that they did in 2021, a year when they had sufficiently less refining capacity than they have right now. Also, fuel oil, the taxation overhaul in China happening right now, the pressure exerted on companies that didn't pay tax or tried to dodge tax, as you know, the two refineries that were closed down in the summer would very much attest to that. The pressure is increasing on companies to be transparent. The pressure is increasing to be effectively cooperative with the government. If you have, you know, the need to cooperate, if you have effectively the mandate to be as transparent as you can, a lot of folks will die out, but the big private refiners will lead the way into being the most margin efficient companies out there. So again, with Yulong starting trial runs in the beginning of September and gradually ramping up those runs into the end of 2024, there's more space, there's more readiness, there's more appetite in China from the Chinese refiners to buy more, build up those stocks, and effectively exploit the fact that we finally have an environment where we are in the low 70s. This is very much, again, the idea that, and I'm very much focusing on the Asian markets, because the Asian markets seem to be dictating in where demand effectively, how demand feels in the oil markets. Again, we have a European market, which is largely declining, a US market, which is effectively stagnant, and then Asia is the epicenter of potential demand growth. India has been a success story. If you just look at, you know, the stocks of Indian companies, they have been very strong this year. People see the future in India. The refinery capacity build up pretty much India is the only country still out there that's going to build a lot of new refining capacity. Pretty much everyone else has either given up or already reached the point of full saturation. And India's, trick in staying competitive was very much going into the Russian trade, because the Russian trade has effectively created a feedstock cost for an Indian refiner, which is $3-4 cheaper than everyone else's. So effectively, they have the advantage. They also have the advantage of being a non-regulated market, largely, where it's quite easy to operate. And also, there's a tremendous amount of cooperation within India as well, between the companies themselves. So effectively, what this results in is that India will be a strong performer in 2025, next year. We pretty much see Indian refinery runs going higher, Barmer refinery, Visakhapatnam refinery expansion, you name it, there's more capacity and there's more runs happening. But there's one very important but, and that specific but is very much on the left-hand side of this slide. If you just compare the changes, the year-on-year changes in product demand growth, or overall just crude intake growth that you see in the Chinese markets and you see in the Indian markets. And this very much reflects Reid's message about, the cadence or the pace of growth is different between India and China. China in its good days was growing 700, 800, or maybe 1 million barrels per day year on year. India's year-on-year growth in 2025, 2026 would be roughly 200,000 every single year. So it is growing. But because the baseline is lower, because effectively the incremental changes aren't really as big as they were in the case of China, we would never really see a replication of the Chinese pattern in India. In fact, the highest that Indian domestic product demand would go, in our perception, is somewhere between 8 and 9 million, and that's it. After that, it basically tapers off. One potentially interesting story next year would be India's refining capacity is gradually increasing, and it's increasing quicker than its actual domestic demand. So very much into the second half of 2025, look out for more Indian product exports going into the markets. They are price competitive. They are more competitive than say peer that don't really buy Russian or Iranian barrels. So it's really a duopoly of India and China as the most competitive refiners. But India doesn't even have the government pressure that Chinese refiners would have. Doesn't really have quotas. So expect a lot more products coming out of India. It has already been the case over the past couple of years, say Indian ULSD into Europe. There's going to be more of that happening overall. And I just want to finish my presentation again very much an Asia-centric one, because that's where the sentiment is effectively being formed. There's one additional thing that I think will pick up the physical side of things in October, November, and December, potentially as well in 2024. And specifically, the differentials of crudes have dipped to a level when formula prices, as set by Saudi Aramco with its OSPs, or Iraqi SOMO with its OSPs, or Kuwaiti's KPC with its OSPs, the OSPs now are in the money. Whoever nominated, say, into October actually made a very good bet, because October seems to be the first month since a brief period in January, February, when term barrels make more sense than spot purchases. And this is a very interesting development, because again, the term barrels, they dictate how the market feels. That's what everyone looks forward to. The moment that you see, Chinese nominations for Saudi Arabian barrels, everyone just assumes that that's a reflection, that's a proxy for Chinese overall demand, for China's overall appetite for crude. And our call is that China's overall appetite for crude into Q4 2024 would improve. Would that have an impact on flat prices? It would have a marginal one, but because the market is effectively taken over by this massive wave of bearishness, again, this combination of oversupply with a gradually lowering demand growth outlook, the marginal increases would be quite tiny. But look at the physical markets. The physical markets might still reveal a couple of very interesting things into the remaining months of 2024.
Awesome, Viktor. Hey, thanks for that info, specifically on the oil market focused on the Asian region. A lot of good stuff there. I really want to focus in on OPEC Plus. You mentioned that you expect OPEC Plus to hold production steady into next year and possibly into 2026. What is maybe a price target price target you would have if OPEC Plus does decide to go ahead and play the market share game and push more supply into the market next year?
Well, I think that oil prices would need to recover to 80 in case OPEC would actually feel the risk or feel the appetite for the risk of bringing more supply into the markets. There's also one scenario which everyone kind of plays around, toys with, and specifically the repetition of, say, a 2014-15 flooding of the market, which pretty much killed quite a significant segment of the US shale environment. Now, the problem with that is that when the market was flooded in 2014, 2015, it was flooded with a very obvious outlook for growth. So kind of, that you'll have an oil price of 40, 50 by the time you flood the market. But you would also know that by the time, let's say, the decade ends, you'd go back to the levels which are very much, satisfy you and your budget requirements. Right now, I think the biggest problem for OPEC Plus and for countries like Saudi Arabia, which arguably are the most fiscally sensitive in this respect, is they could depress the oil price. Let's say it goes from 70 right now to 40. They could kill off some competition. Some of the US shale players would be out. But do they actually have a guarantee that oil prices would ever go back to 80 or 90? I think here the answer is no. Because again, if demand starts to dictate the mood rather than supply, we don't really have a guarantee that demand is going to recover if the oil market is getting flooded by OPEC Plus. Because a lot of the demand growth, the stagnation that we see, is just natural stagnation. China cannot grow infinitely. India cannot just simply out of nowhere, from being a 5 million barrels per day consumer, it cannot become a 50 million barrels per day consumer like China has become. Because again, as you said, it's very much the patterns of consumption. Patterns of consumption in Europe are just completely separated from any other continent. And even if oil prices, my personal opinion, are 40, Europe still stagnates. Because it has regulatory mandates, because it has, all the renewables targets that everyone needs to meet. Everyone is getting taxed, levied on oil. The maximum amount of political pressure not to have oil demand grow effectively. So I think if OPEC Plus floods the market, it's not a good solution. They might get stuck at 50 and not even enjoy the 70 that we have right now for a couple of years, and then basically start to deal with all the consequences. And they might just have a fiscal problem, not from 2027 onwards, but a fiscal problem right now, immediately. And how many SPOs, how many bond offerings, how many different solutions can there be? There's also a limited amount of solutions that you can potentially tap into to effectively feed that fiscal difficulty. So again, I think 80 is the level where OPEC Plus more or less feels okay. 90 is the ideal level. 80 to 90 is the range that arguably they would be aiming for. Right now, not only Saudi Arabia has a difficulty of consolidating its balance, Iraq, Kuwait, and an increasing amount of other countries also has the same issue. So kind of it's no longer just a one-man show. Everyone wants a higher oil price because arguably, most of these countries have one national oil company that feeds the economy, and the economy still needs to grow. There needs to be more space for it.
Nice. Awesome. Thanks for that, Viktor. And kind of just extending the conversation to non-OPEC Plus, which you spoke about a little bit. And you kind of mentioned shale, maybe that area where you could see most, production be a little bit more reactive to price. Is it a possibility? Let's just assume that OPEC was to hold production constant next year. Is it a possibility that price could touch a level that might incentivize some shale players to actually come off the market? Or is it pretty much set in stone that we see production flatline over the next few years?
Now, that's a very good question. Because again, if sentiment is so bad, what prevents us from sliding a little bit lower than 70? Let's say WTI dips into 65. 65, I think, is a psychological lever for a lot of the shale players, considering, the cost of money, considering all the sort of ancillary costs that you sort of incur in the markets right now. a lot of the markets will start to think whether it's actually, viable to bring oil into a declining market where you already have a price of 65, and it might get actually worse. So if not cutting production, a lot of the production expansion plans that I think companies still entertain for 2025, they might get stalled just purely on the basis that maybe we just keep this resource for, a different time frame. Because I think that at some point we'll reach a stage, especially towards 2028, 29, when the non-OPEC supply growth is no longer that strong. And those would be the years when finally the ESG pressures, not in the US, but the ESG pressures elsewhere start to kick in. The US is still basically regulatorily a really good country to invest into oil. Maybe you wouldn't have the opportunity to do so in, let's say, Gulf of Mexico or elsewhere, but in terms of safety of investment, it's a very good country. In a lot of countries, say in Europe, United Kingdom, you get policed just from taxation, and it's no longer worthwhile to invest in future production. And I think we'll reach several of these stages where non-OPEC supply growth in other areas, say Southeast Asia, Malaysia, Indonesia, Vietnam, Thailand, they all start to falter. Chinese production starts to falter. Indian production starts to falter. And then basically all of European production starts to decline. Brazilian production reaches a peak and can no longer grow just because there's no other new resources to tap into. That could be potentially a period when OPEC Plus can come back into the market. That's very much a 2028, 29 outlook, I would say. If a US shale player plays their card well, they could just as well not produce now and wait for that period when others with their sort of obsolete resource bases or maturing resource bases start to falter. They might wait for it. They might not bring everything into the market now and just bring it, in 5 years' time. Because realistically, we're not going to have a price collapse anytime soon. Barring a COVID event or a global pandemic or an absolute financial meltdown, the supply and demand balances of the upcoming years are roughly the same as the current situation is. So realistically, it's stagnation is the new word. It's not lack of growth, it's not declines, it's just stagnation. And if you like this stagnation, if you can play with it and sort of, optimize your resources around it, for the big guys, stagnation isn't necessarily that bad because it's predictable.
Awesome. Well, that's all I have for you, Viktor. I'll hand it off to you to close it out.
So yeah, on this, effectively, I thank you very much for your attention. Don't forget to submit your questions in case we haven't answered something that you would be a point of your interest and you would be keen to know. Reid and I are fully available, and we'll see you very soon in one of our upcoming webinars and the market outlooks. Thank you.
Thanks.